Imagine waking up one morning, turning on the news, and discovering that a single man just made $1 billion betting against your country. He didn't rob a bank. He didn't hack any system. He simply saw something that the most powerful governments in Europe refused to admit. On September 16th, 1992, George Soros made the biggest bet in financial history. And he won. This is the story of how a Hungarian immigrant humiliated the Bank of England, destroyed the British pound, and left us the most brutal lesson about how money really works. To understand what Soros did, you first need to understand the game. It's 1990. Europe wants to unite, not just politically, but economically. The idea is simple. If every European country keeps their currencies stable relative to each other, they can eventually create a single currency, what we now know as the euro. To make this happen, they create the ERM, the European Exchange Rate Mechanism. The rules are clear. Every currency must stay within a fixed range against the German mark, Europe's strongest currency. Britain joins the ERM in October 1990. John Major's government fixes the pound at 2.95 German marks and commits to defending it. Here's the problem. Britain should never have joined. Its economy was in recession. Inflation was high. Interest rates were already at 10%, crushing families with mortgages. But the government needed to prove it was serious about Europe. So it locked in an exchange rate the pound couldn't sustain. It was like promising to run a marathon when you can barely walk. And someone was watching. George Soros wasn't born rich. He was born in Budapest in 1930 into a Jewish family that survived the Nazi occupation using forged identities. At 17, he immigrated to London with nothing. He studied at the London School of Economics while working as a waiter. But Soros had something most people don't, the ability to see the difference between what the world says is true and what actually is true. By 1992, his quantum fund was one of the largest in the world. And Soros had been watching the pound for months. His analysis was devastating in its simplicity. Britain had high inflation and needed to lower interest rates to restart the economy. But the ERM forced it to keep rates high to defend the pound. It couldn't do both at the same time. Meanwhile, Germany had just reunified. Rebuilding the East cost a fortune, so the Bundesbank kept raising interest rates to control its own inflation. Every time Germany raised rates, the pound weakened further. Soros saw what the politicians refused to see. The pound was doomed. It wasn't a question of whether it would fall, it was a question of when. And he decided that he would choose the moment. What Soros did sounds simple, but it takes nerves of steel. His strategy is called short selling. It works like this. You borrow British pounds, sell them immediately for German marks, and wait. If the pound drops, you buy the pounds back cheaper, return the loan, and keep the difference. If the pound goes up, you lose everything. Soros didn't bet small. He bet everything. He built a short position of over $10 billion against the pound. $10 billion. His partner Stanley Druckenmiller originally pitched the idea of betting $1.5 billion. Soros's response was legendary. Why so little? On September 15, 1992, Soros began selling pounds massively. The market felt the pressure. Other speculators joined in. The pound started falling toward the lower limit of the ERM. The Bank of England panicked. At 7:30 in the morning on September 16th, the bank bought £300 million to defend the currency. It didn't work. At 8:30, they bought more. At 9, the government announced an interest rate hike from 10 to 12%. The markets didn't flinch. The pound kept falling. At 2:15 in the afternoon, the government raised rates to 15%, a desperate move that meant millions of British families would see their mortgages skyrocket. It didn't matter. At 7 p.m., the government surrendered. Britain left the ERM. The pound crashed 15% in hours. That day is known as Black Wednesday. The numbers from that day are hard to process. George Soros made over $1 billion in profit in a single day. His quantum fund made nearly $2 billion total from the trade. That was more money than some countries produced in an entire year. The Bank of England spent £3.3 billion of the nation's reserves trying to defend the currency. Public money. British taxpayers' money. Gone in a day. But here's what nobody tells you. Soros wasn't the villain of this story. The pound was overvalued. Everyone knew it. Economists said so. Traders could see it. Even some politicians admitted it privately. But nobody wanted to be the first to say it publicly, because admitting it meant acknowledging that joining the ERM was a mistake. Soros was simply the person who told the truth with money, and the market proved him right. This story isn't just about one man and a currency. It's about something much deeper. First lesson, markets don't lie. Governments can promise whatever they want. They can fix artificial exchange rates, raise interest rates, spend billions in reserves. But if the economic reality doesn't add up, the market will eventually correct it. Always. Second lesson, asymmetric risk. Soros wasn't a genius because he predicted the pound would fall. Many people predicted that. He was a genius because he understood the bet was asymmetric. If he lost, he'd lose 2 or 3% of his position. If he won, he'd gain 15 to 20%. When the reward is 10 times greater than the risk, you bet big. Third lesson, inaction has a price. The British government knew it had a problem, but it waited. It prayed the market would calm down. It didn't. The lesson applies to your personal finances too. When you know something isn't working, every day you don't act is a day you pay the price of your inaction. And there's a fourth lesson nobody mentions. After Black Wednesday, with the pound floating freely and interest rates lower, the British economy began to recover. The devaluation they feared so much was exactly what they needed. Sometimes, what looks like a catastrophe is simply reality imposing itself on illusion. George Soros didn't break the Bank of England. The Bank of England broke itself. Soros just collected the bill. And that's what makes this story relevant today. Because right now, somewhere in the world, there's a government promising something its economy can't sustain. There's an exchange rate that doesn't reflect reality. There's a bubble everyone can see, but nobody wants to name. The question isn't whether it will correct. The question is when. And who's going to be on the right side when it does. If this video changed how you see money, subscribe. Every week we break down the stories that explain how the economy really works. Not theories, facts. See you in the next one.